Good day to all. Today we will try to understand all about mutual fund. What is mutual fund? How it works? Who manages it? What kind of investments fund manager do in this mutual fund? So we will know all about in-depth idea about mutual fund and how it works. As we know, mutual fund is a pool of money collected from multiple people. Like in one fund, many people can contribute, and then a fund manager manages this fund. Now how he manages the fund? By investing in diversified products in different asset class. He invests and he try to maximize the ROI on your behalf, so that at the end you will get maximum return on your investment. So let's start step by step and try to understand how things move. The first question is, how does a mutual fund works? Means what exactly happens in it? So investors, individuals, they get NVA, means net asset value. Against your fund you will get NVA, and then on the back end the fund manager will buy a different asset class like stocks, bonds and other money market instruments and invest in these asset class to maximize return on your fund. Mainly returns are generated in the form of capital appreciation, means whatever your investment is, that will also grow. In some cases you can get a dividend payback also, like if the investment is in equity and that company is giving a dividend or announcing a dividend, then the end user will also get. The fund performance is tracked by, as I said, NVA, like per unit value, and it all depends how much fund you had given, and accordingly you will get the NVA. Now the second step is to understand what types of mutual funds available in the market and which one is good for you to invest. Different mutual funds have different kind of risk. So the first asset class in which fund manager invest is equity. Even if we talk about equity, there are different categories inside the equity where the fund manager in investing and try to get higher returns. Risks are also higher, but it's their job to manage the risk and return for you. So if we talk about the category, there are large cap mutual funds, like some fund manager or some funds are there in which they will invest all the pooled money in large cap companies. Large cap companies means the listed top 100 companies, they come in large cap. So from 65 to 80% of total AUM, asset under management, in other words the fund collected against that fund, will get invested into large cap, and balance fund manager has flexibility to do maneuvering little bit in different kind of funds. The second is mid cap fund. You can also go and invest in mid-cap mutual funds. In that, what happens? The fund manager invests in all the mid-cap companies, means from 101 till 150th company, means from 101 company till 250th company. So next 100, after large cap 100 companies, next 150 companies are under mid cap. So all your funds which you had invested in mid cap fund will get invested in this. Here also, as per guidelines, 65% of the total fund collected can be invested. Small cap, again, all the companies who are listed below 250 ranks or number 250, they are comes under small cap. And risk reward ratio is higher. Risk is higher, you can get a return on higher basis also. Here also 65% is the bottom line, and that much fund could be invested in this small cap companies. Now again, what are the difference between large cap, mid cap, small cap? So these are the categorization depending on your appetite, risk appetite. You can invest in these funds. The next fund is large and mid cap. What happens? That fund manager invests a portion of your fund in large cap and a portion of your fund in mid cap. So at same time you are invested in both the large cap and mid cap. The proportion is 35% should be invested in large cap and 50% should be invested in mid cap. The next is flexi cap. In flexi cap, what happens? That fund manager is fully authorized to invest as per his analysis, means he has flexibility to invest in either mid cap or small cap or large cap. The next category is multi cap. In multi cap, same time the fund manager is authorized to invest in large cap, mid cap and small cap, and the proportion should be 25% to each, and 25% he has flexibility in which he thinks that will perform better, whichever segment he can put the extra weightage on that. The next category is thematic. What happens? The fund manager picks value based share or growth based share where he thinks the value is under the current, where the fund manager thinks value is under the par. So he try to invest in that and then maximize your return. Same way, the growth where he thinks, okay, valuation is high, but still that company holds the growth story. We can anticipate a rapid growth and better return. So he goes for that. The next is sectorial fund. What happens in sectorial fund? The fund manager goes for specific sectors like banking sector. So in that fund, if suppose you had gone for sectorial fund, then all your pooled money will be invested in either banking sector. If you had picked the defense sector, then it will go in defense. Same way, pharma, IT, FMCG. There are a lot of sectors in which fund are already working, and fund manager, they analyze the data, they see the growth, they see the historical data, and based on that they decide that okay, which they have to pick and how they have to invest in that. After equity comes the debt fund. In mutual fund, you have debt fund options also available, where all your pooled money, all your funds will get invested into debt funds like short-term funding, short-term funding or ultra short funding, money market like treasury bills, commercial paper, certificates of deposit, liquid funds. You must have heard about bonds like corporate bonds or GSEC funds, like when government issuing some bond, that comes under GSEC bonds, and when corporate or companies bringing, it comes under corporate bond. So mutual fund manager, they invest in debt funds also to stabilize your income, to stabilize your return on investment, because in these funds the income is fixed, the volatility is negligible. So that balances the volatility of your equity fund. So to counterbalance the fluctuation in equity, they go for debt also. And that option you have, either you want to go for only equity fund or you want to go for debt fund, because multiple kind of options you will get when you want or when you plan to go for mutual fund. The next is hybrid fund. In hybrid fund, like I explained, in hybrid fund, what happens? That fund manager will invest portion of your fund in equity and portion of your fund in debt. So you have a balancing mechanism working there. The risk is moderate in that compared to equity, where the risk is high due to volatility. Now, the second key point is structure. How the mutual fund is structured. So if I explain you, one option you have to go for an open-end mutual fund in which there is no closer date. You can buy that mutual fund, and whenever you want to add on some funds, you can do, and that will go for longer period of time without any maturity date. That can go for 5 years, 10 years, 20 years, 30 years. It will go in continuation. The another one is close-ended funds. Some mutual fund companies or some asset management company, they bring the close-end mutual fund, which is only valid for a certain period of time. Open date is, and close date is fixed for 4 years or for 5 years. On maturity, you will get your principal, and then whatever your return on that, altogether you will get the investment plus your return on that. Another option you have is interval fund. In interval funds, once initial opening has been done, after some period of time, or suppose for example every 2 years, 3 years, depends, that if you want, you can again buy. Otherwise, in between, you cannot invest anything in that. So you need to keep in mind what kind of flexibility you have, what kind of fund availability you have, and accordingly you can pick which the mode of investment, means what kind of structure you want to take. Now the third key point to understand is the goal. Means when you are buying mutual fund, you should set your goal, that okay, when you want to redeem it, or what is the purpose of buying this mutual fund. There are many tax saving mutual funds are also available, which the population are buying to save their tax. Every year you will buy at the end of the year or before the closure of the year, and you can save your tax. And generally this tax saving mutual fund comes with a capping of 3-year locking. So you need to keep funds invested for 3 years. Before that, you cannot go and redeem it. The next is retirement fund. If you are planning for a long term, suppose you are planning that okay, this fund I will redeem only when I will retire, that also you can do. That will go for a long term growth. You can keep it for 10, 15, 20 years as per your requirement. Nowadays you have an option also. When you will do your mutual fund, that time only you can take the option of systematic withdrawal plan. So what will happen after so many years? If suppose you are picking after 10 years or 15 years, then after that period, automatically your redemption will start, and on monthly basis, whatever is your fund requirement which you had filled initially, suppose 50,000 or 1 lakh, 1 lakh 50,000, then every month you will start getting that fund. Some people do for children's education. So you need to set the goal, and then accordingly with the time frame you have to pick the plan, that okay, for what I am investing and for how many years I will redeem it. That will help you to track the return you are getting and then do the things in a better way. The next key point is benefit, like how mutual fund is beneficial for you, why you should go for it. See, the most important point is the fund manager. Here you get a fund manager who manages all the funds, and they are professional managers. They are managing this professionally. They are well trained, they are skillful. On day-to-day basis, they are tracking all the company, all the parameters, volatility, internal, external factors which can affect the equity or market. Individually, many of us are not equipped to track all the parameters or all the information and then accordingly do the maneuvering. So we can rely on experts handling our fund and try to generate maximum return. The second benefit is diversification and reduction in risk. When your fund is diverse and then invested, then the risk is on the lower side. Suppose if you are investing all your funds in large cap or all in mid cap, all in small cap, then risk is more. If suppose volatility comes in the large cap, then all your investment can go down. So when it's diversified, some equity, some bonds, some different kind of products, so that will help to mitigate your risk, minimize your risk. The third key benefit is liquidity. In mutual fund, options are there within 1-2 days of time. If you need money in case of emergency, you can withdraw from your previous deposit and still you can keep your mutual fund on a roll. Means your installment will keep going, and whatever fund you required for emergency, you can withdraw from that. The third and most important aspect of mutual fund is affordability. It's very affordable. If somebody wants, then he can start mutual fund with 500 rupees also. It's not necessary that you have to start from 10,000, 20,000, 50,000 like that only. If suppose your income and your savings are on the lower side, then as low as 500 you can start SIP, and slowly and gradually you can plan, save more, and then you can keep infusing more and more funds. Another most important thing is tax saving. As I explained, there are so many mutual funds where you can take and hold and you can save tax. So for that also people are picking mutual fund. The next point is risk. What kind of risk mutual fund has? That it's also very important to analyze before investing, that okay, we are buying mutual fund, what are the risks associated with mutual fund? So of course market risk is always there, because maximum investment is in equity. All the fund managers take exposure in equity, so volatility will come. But yeah, by diversification, proper allocation of funds, they try to mitigate that. If you are investing in debt funds, then your interest rate risk, whenever RBI is increasing or reducing the interest rate, the debt funds rate also varies. So that's also a risk at the level of policy changes and all. Then the credit risk is there. Maybe in spite of better rating, some bonds can go default, and in that case, some of your funds can get stuck. But yeah, at the end, this all you don't have to handle. It's fund manager's job to analyze about the company, about their operations, about their profitability, how they are doing, what policy change government can bring, how it can affect your fund, how can it affect your returns, and accordingly they do the maneuvering. They have options, they sell, they buy, so they keep doing these things to protect your interest. Now the next key point is, how should you start investing in mutual fund? So many of you must be aware there are so many AMCs, asset management companies, who are handling all these mutual funds. They are bringing new and new funds where you can invest. There are options where you can invest a lump sum amount, or if you want, you can go for SIP, systematic investment plan. If suppose you have a fund available, then you can go for lump sum. If you are banking on some monthly income which comes to you every month, then you can pick for SIP, where once your fund available in your account, then SIP can go from there. Also, as explained previously also, it's very important to define your investment goal, risk tolerance, time horizon, like for how long you want to stay invested, what kind of risks are associated with this, what is your goal, for what purpose you are investing. So these things, once you will analyze little bit and discuss before investing, that will help you to build your mindset accordingly. So now the next key point is taxation. How taxation is applicable on the mutual fund. So this is very important to understand that whatever fund you are investing, there is no tax on that, but whatever gain you will do on your investment, the tax liability is there and you have to pay. For short term, it's 20%. For long term, it's 12.5%. Now, how to define short and long? If you are buying some mutual fund and selling within a year only, or redemption you are doing within a year only, then you are liable to pay 20%. And if you are holding more than 1 year, then your liability is of only 12.5% on the profit made, and plus you will get 1.25 lakhs of exemption. So up to 1.25 lakh if you are generating from your capital, then you don't have to pay, and whatever more than that, then you will pay. When we talk about the debt fund taxation, whatever profit or whatever income you will make from the debt fund, that gets calculated as per your income slab. So depending on your income, in whichever slab you will come, your calculation will come, you have to pay. Now, if we conclude this, I think this must have given you a clear idea that what is mutual fund, how you can pick, how you can go for it, and how you can start investing. Setting the objective, setting the time frame, checking the risks behind that, it's very important. So all these things you can analyze little bit, you can discuss with your fund manager, and then you can go for it. For more informative videos like this, please like my video, subscribe it. If you have any questions or any further information, you can write in the description box and I will be glad to reply to your messages. By the time I come with next video, stay safe, stay healthy. Thank you so much.